Let's understand why Tesla owner Elon Musk is no longer laughing about BYD. My name is Andrew Stotz, and I want to welcome you to the Valuation Masterclass case study. The company we're going to be looking at is BYD. And the title of this presentation is BYD is benefiting from the booming Chinese EV market. Now, in this case, I'm estimating BYD's value is about 277 renminbi per share, which is implying an upside of about 30% from today's price. My past report on Tesla valued it with a 30% downside. Now, this is derived from my DCF-based valuation using a WACC of 9.7 and a terminal growth of 3%. The highlights are: first, expect sales to surge due to the rising demand and effective pricing strategies, and lower costs for EV batteries could lead to gross margin improvements, and strategic investments set the stage for sustainable long-term growth. There are various challenges. I think one of the biggest ones is geopolitical risk. But for now, let's look at this company. Now, there's a couple things that I would point out. I'm going to grab my pen here and just want to show that the company is trading on a PE of about 14 times 2024, and it also is trading on a price to book of about 9 times. So it's not super cheap on a price to book basis, but on a PE basis, yeah, it's reasonable. On a EV to EBITDA basis at about 7 times, so not that expensive, and you're getting an ROE that's really ramping up. It was almost 21% here in 2023, and my forecast is that it's going to rise even further as they continue to hit economies of scale. Now, this report was originally created by my Valuation Masterclass Bootcamp number 13 graduates, and then I went through and did a lot of work on it to try to upgrade it. Now, remember, this is not investment advice or a recommendation. Now, to get this full report and my checklist of how I structure my valuation reports, just click the link in the description below, and you'll be able to download those.
You don't see them at all with competitors. No. Why is that? I mean, they offer a lower price point.
I don't think they have a great product.
So this is Elon Musk kind of laughing at BYD and saying, I don't see them as a serious competitor. I don't think they have a great product. This was some years ago, and I would say chances are he's probably not laughing so much now, although he doesn't have anything to be down about. Of course, Tesla has done phenomenally well also, but BYD, what the point about BYD is that BYD is coming up as a competitor, and I think the competitiveness of BYD is pretty significant, and the expansion and the aggressive expansion is significant. And so let's continue to look at the actual business and what's going on. Elon Musk said now, if there are no trade barriers established, they, meaning the Chinese EV manufacturers, will pretty much demolish most other car companies in the world. Now, he just said that on a post-earnings call with analysts on the 25th of January in 2024. Now, I'm recording this right now. It's the 20th of April, 2024. So he's definitely woken up to that challenge that's going on there. So let's first get an understanding of BYD. So let me just explain a little bit about BYD. That's a little small there. Hold on 1 second. All right. So BYD, let's see if I can, yeah, there we go. So the company called Build Your Dreams is a leading global technology company, and it was founded in 1995. It's incredible how young this company is. As a rechargeable battery maker, and is now a leading automaker. It also is in rail transit, new energy, and electronics. And the company is one of the leading rechargeable battery manufacturers, supplying companies like Samsung and Dell. Now, they sold 3 million cars in 2023, which is incredible. That's a second place in the global battery electric vehicle market, or BEV market, with about a 17% market share compared to Tesla's 20%. And also, let me explain the stories that I was talking about. The first one is I expect sales to surge due to the rising demand and effective pricing strategy. So BYD in fourth quarter sold more than 500,000 battery-only vehicles, surpassing Tesla's 485,000 units during the same period. This made BYD the world's top electric car manufacturer for the first time in that quarter, not for the year, but in that quarter. But it shows the acceleration that the company's going through. And of course, demand for EVs keeps rising, and Morningstar is predicting that it's going to account for 40% of global auto sales by 2030. And this is driven by expected lower price of EV cars due to falling battery costs. And ultimately, due to this increasing demand and competitive prices, I would expect sales to show an annual growth rate of about 22% based upon my research and the research I've seen from some of the others. And what I would say about the company is that, and about the growth, EVs are hard to expand in markets where there's not a lot of infrastructure, and developing markets. I think Toyota has very good positioning in a lot of the emerging and developing markets where it's far away. I mean, the grid is not stable. In fact, I just had a call with a friend of mine from Nigeria, and he couldn't make it because the grid was down and the electricity was down. And that's the point. So let's go back into the presentation and look at the next thing. Lower costs for EV batteries could lead to gross margin improvements. Now, Goldman Sachs is predicting a significant decline in global battery prices. And by 2025, the idea is there would be a 40% reduction in these battery prices from 2022. Falling prices of EV raw materials such as lithium, nickel, cobalt drive this decrease. Of course, if that reverses, well, then we're in for trouble. But for right now, that's the expectation. Now, China will be the #1 global lithium-ion battery supplier by 2024. Nobody even comes close. In fact, it's kind of funny listening to people in Europe and people in the US talking about getting electric vehicles when I don't know if they realize it. They're basically getting all of that lithium is coming from the processors in China. Now, this should help drive down the cost of raw materials related to lithium-ion batteries and could lead to a gross profit margin above 2003's 19%, which was already a good improvement there. Now, strategic investments set the stage for sustainable long-term growth. So the company's investing about $14 billion in developing innovative features to support this shift towards intelligent vehicles. And I think you can't really compare this company to Tesla when it comes to the intelligence in the vehicle, but still, there's a huge amount that they've done at BYD. In fact, even at my home here in Bangkok, there's a BYD car parked downstairs. Building on its success, which it's had in Kenya, the company plans to enter the Rwandan EV market, according to Monitor Intelligence. And the African EV market is expected to grow by 17% from now until 2029. It's interesting. I mean, I can't imagine that Africa is going to be a big market for that, for the EVs, and Rwanda in itself, probably not. But I guess BYD is making a point that they're expanding into Africa. Now, also, BYD has recently built a factory in Hungary, making it a major player in the EV cars and battery production in Europe. Europe is the second largest EV market and is expected to grow at a 10% CAGR from 2024 to 2029. These moves should drive long-term revenue growth and enhance BYD's competitiveness and create new market opportunities. Of course, if we do see a case of the EU regulators slapping on tariffs and putting on other taxes on BYD vehicles, then that's going to slow this down. But at least they've got their production operations set up in Europe. Let's continue on and look at this in a little bit more detail. So this is the industry outlook. And basically, it's a strong industry. Everybody wants EVs. At least they say they want EVs. Now, despite a broader industry slowdown for typical ICE cars, internal combustion engines, EVs are expected to be the growth driver. So McKinsey said, according to them, in 2022, that 2.8 trillion global auto market is expected or projected to grow by 4% annually to reach about 3.9 by 2030. And I show the composition of that over on the chart. Here we can see the EV vehicles rising as a percent of total, right? EVs are expected to surge by 21% to 15 million global units. And the share of EVs in the new vehicle sales could range from 10 to 50 by the time we get to 2030. That depends on regulations. That depends on supply of raw materials and the like. I would say that's an optimistic estimate, but That's what some people are saying in the know, like McKinsey. Now, Chinese automakers are challenging the legacy players. In fact, 7 Chinese automakers disrupted the top 20 rankings, with BYD taking second place in EV market share for the first time for the first 3 quarters of 2023. The Chinese automakers are leveraging lower cost government support and increased R&D investments to compete on price and features. Now, this new dynamic pressures traditional players to innovate to uphold their dominance. It is worth mentioning about the concept of competition. And, ultimately, one of the complaints that automakers in Europe and US will complain about is that there's subsidies going to the Chinese automakers from the government. Now, if some people believe that there is literally, the world is on fire and there is a crisis, a climate crisis right now, if the Chinese government was willing to sell vehicles at a lower price because they're subsidizing those vehicles to Europe and US, and you believe that there's a climate crisis happening right now, what a great opportunity for the Chinese government to subsidize for the world EVs. It's a little hard to imagine that the countries would accept that and companies would fight back, traditional companies, but it's just a thought. All right, so now let's continue on and let's talk about the third thing. Supply chain complexity remains the top challenge, particularly for EVs. So ultimately, the EU's carbon border adjustment mechanism applying a carbon tax to selected goods for 2026 is expected to increase input costs for EU car makers. Now, a complex and sensitive supply chain gives more leverage to the battery suppliers. Here comes the EU bureaucrats coming in to put in new legislation. I can tell you from my experience observing the EU legislators, and let's not even call them legislators because that would imply that they're necessarily elected. But what I would say is the EU regulators, basically the unintended consequences of so many of their regulations are enormous. And I only expect that the unintended consequences of these regulations will be enormous too. What do you think? What do you think about the success of regulators? I'm a little bit skeptical. But also what we can see is stricter regulations around the environment and that impact related to mining, could be a problem. So let's continue on to understand more. In BYD's fourth quarter, revenue was up about 15% due to increasing volume, and its gross profit grew by 32% despite the increase in COGS by 12%. So it was a pretty good result. And I think the key thing on this result is just looking at the gross margin line, which went from 17 down to 16, then to 17, then to 21, and then to 20. Getting to this level, I think part of what you're seeing is economies of scale as the company continues to scale up. That's been very, very successful for them. So the economies of scale is a major contributor. Now, almost 97% of analysts are bullish on BYD. So I have to admit that my opinion of a 30% upside is not outside of consensus. The consensus target, in fact, is even more optimistic with a 37% upside. Now, consensus is expecting gross profit margin to decrease slightly from almost 19% in 2023 to 17%, and then rise again in 2026. I'd say that's where I would differ from consensus, in that I'm expecting a little bit faster rise in the gross profit margin. Now, let's understand the business here. First, BYD's total 2023 revenue was about $602 billion, with EVs contributing about 81%. And Chinese demand now accounts for 73% of total revenue. And what we can see here is that BYD offers 3 distinct personal EV brands tailored to different market segments. There's Dynasty and Ocean, and they are 2 of the series targeting the conservative and youthful markets. And then there's Denza and Yangwang brands, which serve the high-end segment. And the company also produces electric buses and other types of things. But ultimately, 81% of the revenue comes from EVs. Now, mobile handsets is a whole nother part of their business, and these other items account for 19%. It's pretty incredible that this company is more than just an auto manufacturer. Now, I want to walk through my 4 elements of FVMR, fundamentals, valuation, momentum, and risk. Let's first look at, though, the overall rating at the top, where I'm rating the company against 2,650 non-financial companies in China. That's a huge data set of companies. And what we can see is that BYD appears attractive relative to these companies. It's rated in the second decile, which means in the top 20%. What else can we see here? Well, the fundamentals, the company's also ranked in the top 20%. And what you can see is asset turnover is rising. And I think this asset turnover rise is probably one of the most significant things that tells us that economies of scale are kicking in. And ultimately, what you see from that is return on assets rising and return on equity rising to a very respectable level. That's a huge move for the company. Now, the company's moderately attractive because as of the past 12 months, we've got a PE of about 21 times and a price to book of about 4 times, or it depends. If we look at the full year for 2022, it's about 7 times. But ultimately, the company is not cheap. It's kind of middle ranking for valuation. Now, it's highly attractive on momentum. You can see W is worst, of course, and B is best. And what we can see is strong revenue momentum that just has not stopped. It's at 42% in the past 12 months. And then recurring EPS growth, very strong. And also the price change. The price change has slowed down quite a bit, but the balance sheet risk is moderate. The current ratio has improved recently. And also we can see that net debt to equity is reasonable. And the beta is a little bit high at 1.5, but I wouldn't say it's a major risk. So overall, from an investment perspective, I would say it scores very well on my scorecard. Now, also, I want to look at the company's profitable growth score on my world-class benchmarking scorecard. And here we can see that the company is almost ranked the worst among 930 consumer discretionary companies globally in 2021, but they were able to bring that back in 2022. And in the past 12 months, it's ranked at about 5. And that rank is really coming from the strong growth. And that growth is coming from the strong level of revenue growth that we can see right here. And it's that revenue growth that is ranked a 1 on a scale of 1 to 10 relative to 930. That means this company is flying compared to consumer discretionary companies worldwide. Asset efficiency is improving, and of course, it's sales growth that has been the main driver. Now, let's look at the forecast. The company is kind of incredible because the company produced a net profit of about 3 billion and renminbi, and up to 17 and up to 30. I expect now that they're going to hit a huge increase that's going to come as they continue to expand. Cash on the balance sheet is pretty significant, about 118 billion renminbi relative to about 679 billion total assets. Debt levels are short-term debt's somewhat high, but not out of control. Long-term debt is very, very short. So remember that interest rates in China actually are very, very low. Now, maybe it makes sense for them to start to switch some of that short-term into longer-term debt. But the company's also sitting on a large amount of capital. And we can see the book value per share going from about 18 up to 19. And then I'm expecting that to continue to rise pretty steadily. From a cash flow basis, you can see CapEx has been 30 to 120 billion renminbi. And I'm expecting a reasonable amount, 80 to 94. So I'm not overly optimistic on the amount of investment that the company's going to do. On a gross profit margin basis, this is the thing I'm highlighting particularly. It's gone from 12 to 16 to 19, and I'm expecting 19 for the next 2 years and then up to 20. But keep in mind, in September and December, it's hit that 20. And so I think that that's opportunity to stay up at that level. And the net profit margin is, of course, rising and ROE is rising. And I think that this can rise up to as much as 30%, particularly because not only is net margin rising, but also the asset turnover has significantly improved. And I expect that to continue. And that drives ROE. Now, let's look at the free cash flow to the firm. That's this line right here, free cash flow to the firm. And what we can see was there was some huge investments. And now I'm expecting the investments are going to come down and we're going to have a positive and strong level of free cash flow to the firm. If we look at the company on a forward price to book multiple, it looks very expensive compared to the consumer discretionary sector at about 9 times price to book. but also it's generating about a 25 or 25% ROE. So to some extent, there's a justification in there. Now, if we look at the forward PE, it also it looks a little bit better. The PE right now is about 14 times, and we can see a growth rate of 51.6% that's happening in 2024, and then 35.9%. So from a PEG ratio basis, it looks interesting. Now let's get down to the free cash flow valuation. I want to walk through some of this. So I'm assuming a risk-free rate of 4% and a 7% Chinese equity risk premium. That gives me 11% return in the Chinese market. I would say that that's probably a bit high. I could conceivably bring that down, but if I did, of course, it would increase the value of BYD. I'm using a company beta of 1.25, which gets me to a cost of equity of about 12.8. I think that's reasonable, if not maybe a little bit high. And also what we can see is that I'm expecting about 28% of capital structure coming from debt, which brings the weighted average cost of capital using a cost of debt of about 2.2 down to 9.7. Now, you could argue that my cost of debt is a little bit low, so maybe that comes up a bit for that 28%, but that 9.7% our weighted average cost of capital, I would say, is actually a little bit high because of my cost of equity. Now, what we can see here is a breakdown for dividend discount model valuation and free cash flow to firm and free cash flow to equity. I really want to focus on free cash flow to the firm, and what we can see here is 29% of the value is coming from the period from 2004 to 2008, that discounted value, and then 47% is coming from the fade period, where I'm expecting that profitability will eventually fade. And then 36% is coming from the terminal period. This just shows that I'm not putting too much of the value into the terminal period, which often happens, is a mistake that people make in their valuations. So I just looked at a sensitivity where I tried to understand what would happen with a small change in the sales. So if sales, my current forecast for revenue growth is 22.4. If that was to increase to 24.6, just a little bit, that would cause the value to go up to from 277 up to 294. So there's some pretty significant sensitivity, and I think that is part of what I'm talking about of economies of scale. So I mentioned that there's a few different risks here at the beginning of this, but I just want to highlight the rising geopolitical risks, of course, between the U.S. and if it's a risk between the U.S. and China, the U.S. has a lot of pressure on Europe, and so there can be a lot of breakdown happening there. So that's definitely a risk. And then there's other risks related to social and environmental issues and the like. So this wraps up my analysis of BYD. What do you think? If you want, you can download this presentation and get my structure on how I, my handout on how I structure my valuation reports. And you'll be able to get this report and also that structure if you just go to the link below. So that's why Tesla owner Elon Musk is no longer laughing about BYD. Let me know your comments in the your thoughts in the comments below.